Commodities across the board are down, right?
Commodities across the board are down, but none is more so than oil, which everyone is focused on right now. The current price environment is kind of like a stress test for these oil producers, whether they're sovereigns or whether they're private companies. We know the oil cartel OPEC is in pain with the majority of its 12 members over their budget because of the 30% drop of oil since its peak. Jamie Webster over at IHS Energy says that right now you've got 8 out of 12 countries over their budget. That's compared with 5 over 12 in 2011, 2012, and 2013. Now, with NYMEX trading below $65 a barrel earlier this morning, NYMEX crude, I should say, only Qatar and Kuwait will still be able to balance their budgets next year if prices stay at these levels. So it's something to keep in mind, which means governments will be reducing their spending, reducing their subsidies, perhaps looking to develop other industries to make up for their over-reliance on energy. It could lead to social unrest, certainly political uncertainty as well. The thing with OPEC that's important here is that OPEC's leverage on global oil prices is limited because total world supply of oil has been rising. We've got a chart that really highlights this, and what it shows is that oil supply overall across the globe has been rising, even as OPEC's share has been down versus a year ago. That's your white line. Total oil supply is blue. And all of this is because of the dramatic increase in supply from non-OPEC countries, the yellow line.
Like us.
Like the United States, notably the United States. And OPEC said as much last week.
Right. Well, yeah, I mean, it sounded like they were basically like a cartel targeting the U.S. Oil producers. Okay, so U.S. oil producers here, though, I mean, at what point do they say, you know,
that's enough.
That's
Throw
enough.
their hands up in the air.
Right.
It's a waiting game. It's like a game of chicken.
I was going to say, when do they squeal? But okay.
Billionaire Harold Hamm, who runs Continental Resources, one of the biggest leaseholders in the Bakken Shale, says he will continue to drill. And he says the company continue to profit well below $70 a barrel on WTI, and output's unlikely to fall for at least a year. But investors have already discounted ahead because shares of Continental Resources plunged 20% on Friday, and the volume in those shares 3 times the 3-month full-day average. Friday was only a half day of trading, which gives you a sense of how quickly investors are abandoning ship. Now, ITG, which is another agency, estimates that it'll take 6 months before lower oil prices actually slow production growth from U.S. shale, because a lot of these companies have already invested in the equipment, invested in the drilling. They're not just going to turn the spigot off. According to the IEA, only about 4% of U.S. shale production needs oil at $80 or more to be productive, to be profitable. Companies have cut costs by being much more effective and efficient in their production. They really know how to cut costs, and they're really putting that to work right now. And most drilling in the Bakken formation, Betty, can remain profitable at or below $42 a barrel. So that's a long way off.
So that's better news than what we had originally thought then. At least better news for them in terms of when they really start to see red. All right, Scarlett, thank you so much.
Anytime.
Scarlett Fu, our Chief Markets Correspondent.